Our point of view is that gold is the building block of the portfolio. That's the baseline. It's roughly 25% of our model portfolio. And
25?
25, and it has been like that for 2.5 years now. Our next target is $5,000 because of the question mark on the dollar. As long as the US economy has growing debt, spiraling debt, more than $36 trillion, with a deficit, with no real economic plan to reverse that, the dollar will keep on dropping in value. It's the US dollar dropping in value against gold that is pushing gold prices up.
Welcome to another edition of You're in Business. We're joined by Ryan Lemand. He's the co-founder and CEO of Neovision Asset Management. Ryan, we have so much ground to cover in global and regional markets. I want to start off with the Federal Reserve decision. What are your expectations, not just for this meeting, but for the ones that are going to come into 2026, which matters maybe so much more, doesn't it?
Absolutely. Thank you for having me, Yusuf, again. Glad to be here. So tonight's meeting, I don't expect it to be substantially different from the previous meeting. We do expect a hawkish cut of 25 basis points. We do expect a division on the board. We do expect some members to be asking for 50 basis points, others to be basically freezing rates. So division will still be there. All of this stems from two things. One is the political pressure of President Trump's administration to cut rates. The other side is basically the absence of data. So you've seen that the PPI, the BLS, will not be issuing it. So the Fed is really moving blind to a certain extent, but they will cut nevertheless under the political pressure.
What about all this talk of liquidity issues in the plumbing or the financial system? What is the evidence that you've seen that confirms this thesis?
So I don't see any liquidity crunch for now. We're seeing that the long end of the treasury is going up. We're above 4.1%. So we had the tunnel going down where rates going down on the 10-year. Now it has broken that tunnel that we're following. But does it reach liquidity stress or crunch? I don't think so yet. It's not showing in a substantial way where it worries us for now.
But the Fed did pump in $13.5 billion in the U.S. banking system in overnight repos. I mean, if that is not some kind of a flag, I'm not sure what is.
Well, would I go as far as flag? Maybe not. We know that regional banks are having an issue. Some private credit funds are having an issue. And I would think of it as a patch rather than actually liquidity stress. Now, Jamie Dimon spoke about cockroaches. I tend to agree with him. But will all the cockroaches be out right now? I don't think so. I think the Fed today has enough firepower to fight it. We've seen that the balance sheet of the Fed is actually dropping, which is a very good thing. This gives them ammunition to fight any more cockroaches coming out.
There's this big debate right now about who is going to take over at the Fed, and we've covered some of it on the program over the year. Donald Trump apparently is now going to launch another final round of interviews, according to the Financial Times, which is going to pit Kevin Hassett against 3 other candidates to replace Jay Powell. So, twofold question. You think Kevin Hassett is going to get it? And if he doesn't get it, who is going to get it?
In my opinion, I think it's relatively done. We've seen him on an off mic talking about it just a few days back. I think it's relatively done that it's going to be Hassett, and that the way forward will be rates going close to zero or relatively low and very easing conditions, because this is the school of thought that President Trump has adopted. Now, this is to a certain extent worrying because we do think inflationary pressures are still there. We still cannot measure yet the effects of all of the tariffs that President Trump has imposed. Tariffs, in our opinion, the effect of it will come 18 months later. So we do think that inflationary pressures could come back unless the US economy goes into recession. A very much needed recession, in my opinion. As an economist, recessions are not bad. They're a good thing. They flush the economy. The economy goes back on a better foot. So if the US economy goes into recession, inflationary pressures would subside. Otherwise, they're going to come back.
But how is there going to be a recession if Kevin Hassett makes it to Fed chair and he cuts rates? That makes a recession very unlikely, right?
So The recession, in our opinion, will come from the demand side, from the consumer side. So if you look at consumption in the US is the cornerstone of the economy. So if you look at it, you break it down, it's mostly coming from the high earners, the top 10% of the US consumers. If you look at medium or low income families, are actually struggling very, very much. Their consumption is actually dropping. Their credit card debt is going up. And I think this is where it could come from. A contributor to this recession could be the adoption of AI and all of the layoff plans that we're seeing. Numerous companies in the US have announced layoff plans of employees. So this is an additional point that could also push the US economy into recession. The third factor, if you remove the effect of all of the AI circle investment that we're hearing about, the top tech companies, Oracle investing into OpenAI investing into NVIDIA, and all along. If you remove all of this, all of the data center investment, the US economy today would be relatively flat from a growth perspective. So if there's any slowdown in all of this AI investment, in addition to the previous two factors I mentioned, yes, the US economy could enter into recession.
So can you put that on a timeline for us? What does the x-axis look like for that potential recession? Is this something sort of beginning 2026, or is this something that could, come a little bit later in the year or even further out?
I will go long risk here and give you a hard stop on this recession. In my opinion, it will be after the OpenAI IPO. The very much awaited OpenAI IPO. We think this will be the peak of the current bubble because in my opinion, we are in a bubble. That would be the peak. And afterwards, I think there will be quite a bit of selling of booking of profits on these positions. And following that, we could see the US enter into a recession.
So what happens to a world where AI takes more and more of people's jobs, right? So that's what your argument is focused on right now. Does that get replaced with something else? I mean, how far out have you done your thinking? Is this something where universal basic income comes into play? Or do you think that's sort of a stop too far?
That's too far for me, in my opinion. Today, I think AI adoption has gone too quickly, too fast. And I can mention it just a few days back. There's a company here in the UAE in one of the financial centers who received a fine of $950,000 because they actually used one of the ChatGPTs, one of the AI tools for client KYC, and most of it was wrong. So the company received absolutely, yes. I was in an AI conference in London just 10 days ago talking about AI, about issues of AI adoption in companies. Most companies have issues around there. So all of the layoffs that we're hearing on the back of AI is way, way too early. And I think that's another contributor to a slowdown where companies will realize they're investing too much into AI adoption, laying off employees too early, and this will be problematic. Companies, before they actually adopt AI, they need two things. Most companies have unstructured, very fragmented data across the enterprise. So they need to, first of all, structure and harmonize their data, structure their data. The second prerequisite for adopting AI is automation. If a company doesn't have automation of more than 50%, I would say even 80%, they cannot actually adopt AI. So you have two prerequisites: data, harmonized AI, structured data, and second, automation. Companies today are laying AI, an AI layer, AI adoption without having automation. And this will end up, in my opinion, with quite some bad surprises for many companies.
So there is going to be a structural change in the economy based on what you're saying, but the companies might still do all right. Certain companies who are providing AI solutions. But are you still cautious on anything related to US and technology because of valuations and because of those structural changes? Or are there any US bets where you're saying, you know what, all opportunities there?
Let me tell you, in my opinion, having lived in the Internet 2000 bubble, which is, in my opinion, very similar, new technology coming out, right? The Internet...
Except we have real revenue here, Ryan. That's what everybody says, right?
Cisco had real revenue. Cisco was the only producer of routers back in 2000. They were very profitable, and nevertheless, they went away. Let me tell you where's the problem. Internet adoption took 10 years. Why did it take 10 years? Because there was no product. Okay, so we were internet, we could go and search for things. This is not a product. internet adoption really took off substantially and started to become profitable when we created that product. And that product is this. This is it, okay? Today with AI, we don't yet have a product, okay? We have a service, we have something that optimizes, makes things more efficient, but we do not yet have a product. If you go back again to the telecom and internet breakthrough, the initial products have gone away. Nokia, BlackBerry, and others, they completely are gone. So what we're seeing today is the very early stage of AI that, in my opinion, will go away. So LLMs, large language models, will be replaced by something called small language models, which is something completely different. I'm sure you use ChatGPT and other tools. The percentage of hallucination is more than 30%. I'm sure that AI has lied to you before and gave you wrong answers. This is called hallucination. So all of this will go away with something called SLM, small language model. This is the future product. So we're still waiting for that AI product that would change things. As usual, we're very early, spending too much money on something we don't yet need.
I have to say, Gemini has been quite a pleasant surprise compared to ChatGPT
100%.
as I've experimented over the last 2 to 3 weeks. I want to talk a bit more about what you're telling clients in terms of asset allocation, right? And the last time you were on the program, you were big on gold. You've always been big on gold, right? And you said at the time that it's going to surpass $3,000 an ounce. I mean, it's done that with all enthusiasm in the world, right? Far above $4,000 an ounce. Best year since 1979, I believe, returns of about 60%. Question becomes, do you stay long this trade or do you start taking profits? That's what I'm wondering. And how far is this going to go into the new year?
That's a question we get from our investors all the time. Our point of view is that gold is the building block of the portfolio. That's the baseline. Okay, so it's roughly 25% of our model portfolio. And 25, and it has been like that for 2.5 years now. You can do the math and see how much money we've made. Our next target is $5,000, and even if it remains hovering around 4,000, 4,200, this will remain the building block, the baseline of our model portfolio. The 60-40 portfolio is pretty much obsolete now, and it has been replaced now with this baseline of gold. Central banks are buying gold. Even Ether, okay? Ether today, they hold more gold than some sovereign countries, some European countries. So today, gold is the basis of many, many institutional portfolios for multiple reasons. Geopolitical, and second, because of the question mark on the dollar. As long as the US economy has growing debt, spiraling debt, more than $36 trillion, with a deficit, with no real economic plan to reverse that, the dollar will keep on dropping in value. So when you look at gold, the rise from 3,000 to 4,200, this is not necessarily the lack of gold or lack of supply of gold. You should think of it more as a drop of value of dollar against gold, okay? So it's like a currency pair. Japanese yen versus US dollar, when this pair goes up, it's either the US dollar dropping in value or Japanese yen going in value. So this is how we see it today. It's the US dollar dropping in value against gold that is pushing gold prices up.
To everybody watching, we'd love to hear from you. Drop a comment below and tell us if you agree or disagree with what Ryan's saying, and also take a moment to hit that like button. We'd really appreciate that. Ryan, the tradition is to put out outrageous calls for 2026, right? And some of the exotic ideas. And Saxo Bank, on the topic of gold, said that China is going to announce audited gold holdings as a surprise. And they'll show that they have enough reserves to surpass the US, and the offshore yuan is going to be partially backed by gold. And so holders can then redeem the gold yuan for actual gold, boosting the yuan versus the dollar. How wild and far out an idea is that?
You know, there are two entities that are working very silently. One is China and the other one is Google. I'll talk about both in a second. So China, the undeclared gold purchases are really very high. They're really very, very high. And I wouldn't be surprised if China comes with a surprise like you mentioned. Like DeepSeek, in my opinion, was just a test balloon. just to see what's the reaction around it. I think China is working on quite a few things very silently and very calmly, and will make some substantial announcements that would look everyone else look bad. So yes, I wouldn't be surprised if they do that. Their gold purchases, yes, they are to back their currency. This is what I would do if I were China today. When I have substantial amounts of debt, they have substantial amount of debts. Their economy is struggling from an industrial perspective, from a consumption perspective. So buying gold and declaring that would be quite a breakthrough in my opinion. The second one is Google. And why Google? Because Google, they are the internet, right? They're using TPUs, not GPUs, for their AI, and they're working very silently. They haven't said anything yet. They haven't announced anything yet. So they're letting everyone work on GPUs and on ChatGPTs. But I think Google will come with a substantial surprise as well.
And then the other theory being that gold is going to climb to $6,000 an ounce and the offshore yuan drops to below 5. Are these things likely to happen in 2026?
Well, that's a very high level. I would believe it if, for example, China goes into Taiwan, if there's a substantial geopolitical event that takes place, if things go really sour between China and the US. So at the moment, there seems to be a détente. There's no agreement. There's no trade agreement. There has been announcements about trade agreements, but nothing materialized. But there's a détente. If things go sour the wrong way between them, yes, gold can hike substantially to why not $10,000 even.
The one that's kind of lost out a little bit has been cryptocurrencies and sort of Bitcoin and Ethereum at the front of that. There was this debate, and I know which side of the debate you were on because you were on the program, and the belief was that it has matured into digital Swiss franc, a non-sovereign store of value in your portfolio. But what I see today is another speculative risk asset, right? Very different from gold and very different from the other precious metals. I mean, how do you reassure anybody who is beginning to have serious doubts that this is not as safe of an investment or reliable as an investment, right? Because the volatility is what can break these things. It's not necessarily the rally or anything else, but it's the volatility.
100%. It's the volatility and the systemic risks behind it, which lies with the whales. So let's compare gold and Bitcoin. If you gave me the choice, I definitely choose gold. This is no secret, you know it. We have our gold stored in Switzerland in a very safe place. It's verified purchases. I can go open the safe, touch that gold. It's perfectly safe there. With Bitcoin, it's different. It's an electronic type of asset. It is an asset class. This is undeniable. But volatility puts off a lot of institutional investors, including us. Do we hold Bitcoin? Yes, we do. Is it a large percentage? No, it's a tiny percentage. Why? One of the biggest risks today for Bitcoin...
What's a tiny percentage? Sorry, Ryan.
It's less than 2%.
Okay. Yeah, go ahead.
One of the biggest risks today for Bitcoin, there are many, but one of them is MicroStrategy. Okay, so MicroStrategy today, if you look at its market value, it's less than its Bitcoin holdings. Does this make sense? Absolutely not. What happens if MicroStrategy today are forced to sell their Bitcoin because the company is not doing well at all? So if they start selling their Bitcoin and they are a substantial holder of Bitcoin, what happens to Bitcoin price? This is not something that you have with gold. Okay, you don't have whales with gold. Yes, you have central banks who are buying and holding to back their currencies. These will not sell their gold. With Bitcoin, it's a different story. And obviously, volatility for us as portfolio managers make it very hard because we have a risk budget. When we manage a portfolio, we start with a risk budget. If you have one asset class consuming a big chunk of your risk budget, that's not a good thing.
Maybe another way to offset some of the higher valuations and to move into other opportunities would be within this region, right? So look at Dubai stocks. They've done quite well year to date, up about 17%. Saudi stocks, on the other hand, are down sort of almost 6%. I'm wondering sort of between the two or even beyond those two, do you go on like an index level or do you do like stock selection within the Gulf? What's the current thinking at Neovision?
Yes, we do stock. All of our investment is stock picking rather than indices. But for individual investors, it's a different story. Obviously, we would recommend for individual investors to go with indices. It's the safest way to do it. rather than bet on specific companies. We are extremely bullish on the whole region. I think the numbers do not lie. We're seeing it literally in exodus from Europe coming to the GCC, particularly the United Arab Emirates, both Abu Dhabi and Dubai, from very talented professionals. And this is actually boosting the UAE as a knowledge economy from talent, from ultra high net worth individuals, from entrepreneurs, etc., etc. So this is boosting the whole economy, and it has reflected on both Abu Dhabi Exchange and Dubai financial market from a performance perspective. As for Saudi Arabia, I think Saudi Arabia today is going what the UAE has gone through 10 or 15 years ago. It's reform, it's investment, it's execution risk. And it's very normal to see these markets go down because investors do not like that until the results materialize, until execution risk drops to close to zero, just like the UAE. But the UAE was expanding, building the highest tower in the world, building bridges, building roads, etc. Investors were actually coming out. They were afraid until execution risk went to zero when the results came out. So Saudi Arabia, I think, will reach the stage where the UAE is today. And this is when we're going to see the Saudi stocks go up. So we are investors into Saudi stocks, particularly dividend-paying ones.
So if I'm looking to pick up a few names, what would be your recommendations?
Well, for regulatory reasons, I won't be able to mention specific names. I can't dive into sectors because I would violate what my compliance allows me to say and not say. But for individual investors, you should go to free cash flow generating companies, companies that are actually paying dividends, and companies that are leaders in their sectors. And here in the UAE, I think you can pick up a few names in your head where you have a handful of companies that are leaders in their sectors that pay dividends and are positive free cash flow. So these are no-brainers.
What about the real estate opportunity set? Because the Saudis are going to open up their market beginning early 2026. And, I just got back from sort of serious meetings there and interviews. And I was surprised by quite a few expats, so people who flew in from abroad who had either bought or considering to buy in Saudi. And, I'm wondering whether that's something you've considered and something that you recommend as well, potentially over, say, a market like Abu Dhabi or Dubai, where, so much is already in the price that you can't really expect the kind of returns that have occurred over the last 3-4 years to occur again.
What's disruptive in Saudi Arabia is their announcement about the Saudi Golden Visa, where you buy real estate for $1 million, roughly 3.6 million riyals, and you get a Golden Visa for life. So this is a breakthrough. When the UAE did that a few years back, this brought a lot of residents who would like to have the Golden Visa based on their real estate investment, and this was one of the factors that helped boost the real estate sector in the UAE. So we think that, yes, this will help boost the real estate sector in Saudi Arabia as well, as one of the factors. So we would be buyers of real estate in Saudi Arabia. Dubai, it's quite specific to specific neighborhoods. I think the real estate sector in Dubai has reached a very, very high level, stabilized up there, and we might be seeing some potential profit taking, which leads to some weakness in price. In Abu Dhabi, again, like for example, if you look at the Saadiyat Island in Abu Dhabi, this has sustained a magnificent price, and that's actually going up. Yield there in real estate in Saadiyat Island is roughly 15%. So we do manage one of the largest REITs in the region, the MENA residential REIT, and we know that for a fact. The Saadiyat investment, the residential villas, has been a fantastic investment, 15% a year.
Let's break that out a little bit more because my understanding is you took over that REIT, correct?
Yes.
And it's actually 9 years old. And then now you control it, supervise it. Talk to me a bit more about, what it offers and how it aims to, provide performance where others have failed.
So this REIT is not open to retail investors. It's really for professional, very, very large investors. There are like 4 or 5 very large shareholders in that REIT. The aim is to buy residential units in bulk, a whole building or a whole compound, and rent out these units and have a property developer under our control to actually manage this property and distribute income that comes from rent. It's actually very simple and straightforward. And it has been a very, very profitable REIT to its shareholders. One, from an appreciation of value and the value of the real estate the REIT holds. And second, from the distribution of dividends, because the yield is double digit.
How much of a difference do you think the Fed cutting interest rates over the next 6 to 12 months is going to make for the property market in the Gulf, right? Because yes, I understand that markets like Dubai, there's a large proportion of people who just show up with cash, right? And buy the transactions all out. But there has been a growing market for the mortgages where, the interest rate change will make a difference. Your conclusion on that?
So mortgage rates, when the Fed cuts rate, they're cutting rates on the very, very short end that gets compressed. The longer rates, they don't necessarily go down. So this is one of the misconceptions that President Trump has talked about. Longer, much longer, more 20, 30 year might not drop substantially. So the effect will be very marginal in my opinion. Now, some variable paying mortgages where they are indexed to actually the EBOR or the LIBOR. So this could drop, but again, the drop is quite marginal. Will it have a substantial effect on the real estate sector in the GCC? I think it will be very, very marginal because as you rightly mentioned, many of the buyers actually are paying cash. And they're not affected by this marginal drop. Even the ones who are taking margins or taking mortgages, they're mostly high earners. So that 25, 50 basis points drop will not make a big difference for them.
The other thing that you talked about last time was private credit.
Yep.
And that's gone into quite a bit of trouble.
Yep.
Right. So we had a few bankruptcies and it sort of caused quite a bit of anxiety. It seems now, at least for the moment, that they've, resolved some of the immediate issues, but it's still a major concern about sort of the broader stability of that sector. What have you done with that? Have you pulled out? Are you saying, no go? Are you staying the course on private credit for those people who want to, spruce up their portfolio on the side away from, core?
Well, if you indulge my analogy, private credit is like a knife. You could use a knife to cut your steak, cut your apple, and it could be very useful. But at the same time, you could cut yourself or kill someone. So it can be very dangerous and it can be very useful if done properly. You have to know how to do private credit properly. So we do manage a private credit fund here out of Abu Dhabi Global Market, ADGM. It's for a company called Tabi, which I'm sure many people know it. So this fund basically is a private credit fund. What it does is it lends money to SMEs. These same SMEs that provide buy now, pay later service to their consumers. So basically Tabi, through their credit system, they have all of the credit details of each of these SMEs. So when the fund lends to these SMEs, it's done in a very proper way with risk limits, with stress testing, etc. And that fund has been generating double-digit returns for the investors in that fund. So when you do private credit in a wild way to companies you don't know very well, without stress testing, going into sectors that are already quite leveraged, then yes, it can be very dangerous. But when it's done properly, no, it can be very profitable, and we're all in it as long as done properly.
What other markets do you like at the moment?
The markets. Okay, so we're still invested into China. We booked some profits. We're still invested into India. We've taken some profits. So we're more leaning towards emerging markets, including the GCC. We have done some stock picking in Europe, some stock picking in the US, though on the small cap and mid cap, we pulled out because we think they might suffer in the coming period, given all of the changes that are happening in the US. And obviously commodities, not only gold. We have copper, we have silver, and we've seen silver has done very, very well. We're also invested into silver, by the way. Palladium as well. So all of these precious metals that are useful today for producing chips and producing technology will go up in value. Silver, I think, could very easily go to $100.
$100?
Yep.
Wow. I want to follow up on China.
Yep.
MSCI China is up almost 40% so far this year. Are they going to sort of open up in terms of doing the right reforms and finally being able to build the momentum that's just been missing? Because it matters to the rest of the world what happens in China.
Amen to that. This is something we're really waiting for, and that's one of the, let's call it the positive black swans we're waiting for, or that very positive tail event we're waiting for. Reform. We've done very well on China, again through stock picking. And if China really opens up a bit more, does a bit more reform, I think a lot of capital from the West will move to China, will move eastwards. We've seen here in Abu Dhabi Exchange, there was a listing of a very famous China-based ETF that is listed in New York Stock Exchange. In our knowledge, this is the first dual listing that happens between New York Stock Exchange and Abu Dhabi Exchange. It's a China fund. So there's a lot of demand for China. But again, that big inflow of capital will happen when there is reform.
Which currency do you think is going to offer the biggest surprise of 2026?
I think US dollar on the negative side. And I think CHF, Swiss franc, on the upside. Japanese yen, we're waiting for the Bank of Japan to make its move. And we've been saying for 18 months now that it's unavoidable that the Bank of Japan will have to increase rates, and by quite a bit, because inflation is coming back to Japan. The longer it is, it's at levels we haven't seen in 20 years. So the Japanese yen could make a big move as well.
Do you think the Bank of Japan is coordinating with the Fed on that move just because of the amount of assets that are tied to, the interplay of the two? I mean, I'd be surprised if they weren't talking on the phone on a daily basis, right?
100%. Excellent point. And that's something I've been talking about as well. They have no choice but to coordinate, because this very famous carry trade where you would borrow in Japanese yen at almost zero and you use it to buy US technology stocks is the trade of the years that we've been living now, 3-4 years. And the amounts are staggering. So when the Bank of Japan increases rates, this could have a substantial impact on the carry trade. Now, we've seen a lot of this carry trade being reversed as we speak, because it's heading towards a disaster if it's not reversed. So they have to coordinate. And I think the Bank of Japan will increase rates very slowly and in very close coordination with the Fed. Absolutely.
What is one of the learnings that you've had from 2025 that have sort of surprised you as an investor and as an advisor, where, you found it a little bit humbling?
Well, it was a frustration, to be honest, Yusuf, and it's not again. So I've seen it in year 2000. Year 2000, there's a very famous company called Global Crossing. Global Crossing went on creating fiber optics all over the United States on the back of the internet revolution. What happened to Global Crossing? It blew up. So today we're seeing it the same thing with data centers. Staggering amounts are being spent on data centers, many of which today are turned off in the US because there's not enough energy to fuel them or to turn them on. So again, it's happening again where, the famous thing of selling shovels, right? So people want to sell shovels on the side of AI, but the spending is so astronomical that no amount of revenue of these tech companies could cover all of the spending. So it's a frustration and a disappointment that it's happening again.
But at the same time, the market's irrationality can outlive, your average bet anyway, right? So, if you're going to wait for that correction, which I don't believe you are, because you're actively diversifying and you're moving away into other investments, correct? So it's not like you have any active shorts on US stocks. Is that right?
I'm an anti-short. Absolutely. It's suicidal today to go against the US market or the US economy for that matter. Shorting is an extremely speculative position that could be done in a very small amount, in a very idiosyncratic way, not systemic way. This is not something I would do ever. It's just, we're very fundamental investors. And when a stock has a price to sales of more than 3 or sometimes 4, it's just senseless to invest, especially when you don't see the product. So rather than be short or long, we'll just sit on the sidelines. And particularly so when there are other opportunities elsewhere. So I can disclose our modern portfolio year to date, we're close to the end of the year, has done 32% up this year without US stocks. It is feasible. So if I have no other option, yes, I would probably buy US stocks.
I'll tell you what, Ryan, I'm a bit surprised though that you've become a fan of silver because the last time we spoke, you said that the central banks are not going to buy it. And that's why you're not buying it. So does that mean there's been a change there as well, or a learning? And you're like, you know what? We're leaving money on the table.
Absolutely. And specifically when we dug into the numbers of the industrial usage of silver. So the rise in silver today is not for accumulation by central banks or investors. It's more on the industrial side. The second thing, silver, and this is what the information we found, is a bit hard to come by than gold. And this is what pushed us to, yes, start accumulating silver in much smaller amounts than gold. But yes, it's a very good investment to make. The second one is copper as well. So we've done the research on silver and copper at the same time, and we invest into both at the same time.
What about the year of some of the massive deals, right? So right now, Netflix and Warner Brothers, and then earlier on we had Electronic Arts. I mean, it's been quite the year. What does it tell you sort of about the market more broadly, right? When you see a deal of the size of Netflix and Warner Brothers, obviously the politics are still playing out and we're not sure yet who's going to have the last hurrah, but it's just unbelievable looking at sort of the billions of dollars playing.
Oh, absolutely. I mean, the US economy, and this goes back to your first question, is flushed with cash. There's so much cash. It's so easy to get cash to do these deals that you're seeing these deals. So in my opinion, this also answers your first question. If the US economy and the financial system and the banking system wasn't flushed with cash, it's very difficult to see these mammoth deals that are happening. Now, on the entertainment side, I'm sad that like the film industry is not like the same as before, as our time when we were younger with the Hollywood movies. But I would love it to go back to this. But yeah, these mammoth deals, I hope they won't kill the film industry.
And what about sort of the politics of Trump and the tariffs? You think 2026, we're going to stabilize a little bit compared to how eventful 2025 has been? Or do you think that we need to prepare for another year of surprises and intensity, which may lead to sort of a major drawdown in valuations across assets?
Well, President Trump has really waved the stick a lot with the tariffs. And I think he realized that this stick has reached its limits. And that is why, if you notice, over the past 2 months, we heard him much less talking about tariffs, threatening, etc. Because yeah, that stick has its limitations. And I think he has realized, along with his advisors, that it could backfire on him. The second thing is from a consumer perspective. We're hearing a lot of complaints about consumers in the US complaining about inflation. And some of this inflation has come from tariffs. And it's in the news. It's no secret. Some of the advisors for Trump have told them, well, there's lots of complaints from consumers in the US, residents and citizens, about inflation coming from tariffs. So I think this is why he's calmed it down a little bit. So I think 2026 will hear a little bit less about tariffs and more about China, Ukraine, Russia, more geopolitics rather than pure tariffs.
And what about crude oil, right? Energy prices, which are so fundamental to sort of the lubrication and functioning of Gulf economies. We're just barely above $60 a barrel. It doesn't necessarily infuse me with confidence looking at some of the technical charts. Need to prepare for difficulties there to the downside?
Yes, I think oil prices will have some pressure, subject to us not having any war anywhere and a place where oil is related, like Middle East or anywhere else where there's disruption of supplies. As long as we don't have that, yes, there will be pressure on oil prices. Now, many of the GCC economies, particularly the United Arab Emirates, have weaned themselves from oil revenue. So the economy is doing very, very well without actually oil revenue. So we're less concerned there. I think Saudi Arabia also is on its way of reform, just like the UAE did 15 or 20 years ago. So they are on the right path. As long as the country any country is on the right path of reform, diversification of revenue, we would like to be long risk of that country because it is heading in the right direction. This applies to any emerging country or emerging market. Reform is essential to get investments.
And then a quick closing thought on the new year for you personally, right? I mean, from my end, right? So it's, continue to grow on all kind of fronts. I'm wondering for you, obviously not physically grow because I'm already tall, right? So the last thing I need is to move up in height. But, in terms of the year that was and what you would like to do in the new year, what would you be able to share on?
Well, I can tell you 2025 has been a very difficult year, but in a positive way. A lot of work, lots of projects, lots of challenges as well. So I'm traveling on the 17th of September back to France, to Paris, to spend it with the family the last few days. I would like to go walking, reflect a bit, maybe code a bit. I empty my head with coding and decompress before getting back in January and have the floor running on the many, many projects we have upcoming and prepare for I think, what will be a very bumpy 2026.
All right, Ryan, this has been incredible. So thank you so much for joining and sharing some of your views. That's Ryan Lemand.
Thank you.
Thank you for listening to You're in Business. If you've enjoyed the conversation, like, share, and subscribe. See you next time.